Something unusual is happening in the financial world right now. Gold investors are watching every move coming from Washington. Silver traders are preparing for what could become a major turning point.
We are following breaking economic news this morning as the markets react
two of the
sharply
biggest
to the new
names in American
prioritization
finance
report.
suddenly
All
made
eyes
headlines.
are on the bond yields.
Kevin Warsh delivered comments that immediately caught the attention of Wall Street, while Jamie Dimon issued another urgent warning about the economy and financial markets. Could these statements change the future of gold and silver prices? Or are investors missing an even bigger story that is quietly unfolding beneath the surface? Stay with me, because what we are about to uncover could completely change the way you look at the precious metals market. The financial markets are entering one of the most important periods in recent years. Investors are trying to understand where inflation is heading. They are closely following every Federal Reserve signal. They are watching the strength of the U.S. dollar.
If we look at the data visualization on the main screen, the upward trend in emerging markets is undeniable. This changes our year-end forecast.
At the same time, gold and silver continue trading in an environment filled with uncertainty. Every day brings new headlines about inflation, government debt, geopolitical tensions, and central bank policy. Yet despite these powerful forces, precious metals have experienced periods of volatility that have left many investors searching for answers. That is why the recent comments from Kevin Warsh attracted so much attention across financial markets. Warsh is widely respected because of his experience as a former Federal Reserve governor. Whenever someone with his background discusses monetary policy, inflation, or the future direction of the American economy, investors pay very close attention. Warsh has consistently emphasized the importance of restoring confidence in monetary policy. He has warned that inflation cannot simply be ignored and that maintaining credibility remains essential for long-term economic stability. Those observations matter because inflation expectations often play a major role in determining the direction of gold prices.
Look at the price on this.
Gold has always been viewed as a store of value during periods when investors worry about the purchasing power of paper currencies. If inflation remains persistent, or if confidence in monetary policy weakens, many investors naturally begin increasing exposure to precious metals. That relationship has appeared repeatedly throughout modern financial history. At the same time, Jamie Dimon continues delivering warnings that financial markets cannot easily dismiss. As the leader of one of the largest financial institutions in the world, Dimon has repeatedly cautioned investors about growing economic risks. His comments often focus on government debt, geopolitical uncertainty, inflation, and the possibility that markets may be underestimating future challenges. When experienced financial leaders begin expressing concern, investors naturally start paying closer attention. Markets are built on confidence. When confidence begins changing, asset prices often follow.
We are hemorrhaging.
One reason these recent developments matter so much is because they arrive during a period when the Federal Reserve continues facing difficult decisions. Inflation has eased from its highest levels, but it has not completely disappeared. Policymakers continue balancing the need to support economic growth while making sure inflation remains under control. Interest rates remain one of the biggest drivers of gold prices. Higher rates generally create pressure because gold does not generate interest income. Investors can earn returns from Treasury securities savings accounts and other fixed income investments. This often reduces demand for non-yielding assets during tightening cycles. However, the relationship is never that simple. Markets constantly look ahead. If investors begin believing that future rate cuts are becoming more likely, gold often starts moving before the Federal Reserve actually changes policy. Expectations frequently influence prices more than official decisions themselves. This explains why every speech, every interview, and every policy statement receives enormous attention from traders around the world. Investors are not simply reacting to today's conditions. They are trying to predict what financial markets may look like 6 months from now. The U.S. dollar adds another important piece to the story. A stronger dollar often creates temporary pressure on gold because international buyers must spend more of their local currency to purchase the same amount of gold. A weaker dollar usually creates the opposite effect by improving global demand. Currency markets therefore remain closely connected to Federal Reserve policy. If investors expect interest rates to remain higher for longer, the dollar often strengthens. If expectations begin shifting toward future, easing the dollar may weaken while gold receives additional support. Silver deserves equal attention because its market dynamics differ from gold in several important ways. Silver is both a precious metal and an industrial metal, This unique combination means silver benefits not only from investment demand, but also from expanding industrial applications. Demand for silver continues growing through renewable energy electric vehicles, advanced electronics, semiconductor manufacturing, and artificial intelligence infrastructure. Every major technological transition requires significant amounts of silver because of its exceptional electrical conductivity and reliability. This means silver responds to both economic growth and investor sentiment during periods when industrial demand remains strong while investors also seek safe haven assets. Silver has historically produced some of the largest percentage gains in the precious metals sector. Another factor supporting long-term optimism has been central bank buying. Around the world, many central banks continue increasing gold reserves as part of broader diversification strategies. This trend reflects growing interest in reducing dependence on traditional reserve assets while strengthening long-term financial security. Strong central bank demand creates an important foundation beneath the gold market. Unlike short-term traders, central banks typically purchase gold with very long investment horizons. Their steady accumulation often provides additional stability during periods of market volatility. Geopolitical uncertainty also remains impossible to ignore. Conflicts across several regions continue affecting global trade, energy markets, shipping routes, and investor confidence. Financial markets generally dislike uncertainty because uncertainty makes forecasting future economic conditions much more difficult. Whenever uncertainty increases, investors often begin shifting capital toward defensive assets. Gold has earned its reputation as one of the world's leading safe haven investments through decades of financial crises, inflation cycles, recessions, and geopolitical tensions. Yet despite all these supportive factors, both gold and silver have experienced periods where prices moved differently than many investors expected. This has created confusion across financial markets. Some investors wonder whether precious metals have already reached their peak, while others believe current conditions represent only the beginning of a much larger cycle. History provides an interesting perspective.
The timeline highlights key economic cycles.
Rarely moved higher without
Note
interruptions.
how during periods of
Temporary
recession,
corrections
precious
often
metals
appeared even while long-term fundamentals remained positive. Those corrections frequently caused investors to question whether the rally had already ended. Experienced market participants understand that volatility is a natural part of every major investment cycle. Markets constantly test investor confidence before establishing the next major trend. Emotional reactions often create opportunities for disciplined, long-term investors who remain focused on larger economic developments rather than daily price fluctuations. Another important issue involves government debt. Public debt levels continue reaching historic highs across many developed economies. Financing that debt becomes increasingly expensive when interest rates remain elevated. Policymakers therefore face growing pressure as they attempt to balance economic growth, inflation control, and fiscal stability.
But the recent
Many
growth
analysts
indicators
believe
suggest the
these
previous hikes
long-term
are
structural challenges will continue influencing precious metals over the coming years. Gold has historically performed well during periods when investors become concerned about currency stability, government finances, and long-term purchasing power. The combination of Kevin Warsh discussing monetary credibility and Jamie Dimon warning about growing financial risks has therefore attracted enormous attention because both topics connect directly to the long-term outlook for gold and silver. The question investors now face is whether these warnings represent temporary
protecting
concerns
wealth
or whether they
at its
signal the
very
beginning
core.
of a much larger shift in global financial markets. The answer may depend less on today's headlines and more on what is quietly developing beneath the surface. And once we examine the deeper economic forces now shaping the global economy, the outlook for gold and silver becomes even more fascinating than most investors realize. As investors continue analyzing these developments, another important question begins to emerge. Why are experienced financial leaders becoming increasingly cautious, even while parts of the economy continue showing strength? The answer lies beneath the surface, where several powerful economic forces are beginning to move at the same time. Inflation remains one of the biggest concerns facing policymakers. While the pace of inflation has slowed compared to previous highs, prices across many sectors remain significantly above where they were only a few years ago. Consumers continue paying more for housing, food insurance, healthcare, and everyday necessities. Businesses continue dealing with higher operating costs. These pressures have not disappeared. They have simply become less visible in daily headlines. Kevin Warsh has repeatedly stressed that maintaining confidence in monetary policy requires discipline. Financial markets depend on trust. If investors begin questioning whether inflation can truly return to target levels, uncertainty increases across every asset class. Gold has historically benefited whenever confidence in paper currencies begins weakening because investors naturally search for assets that preserve purchasing power over long periods. Jamie Dimon has focused attention on another growing concern. Government debt continues expanding while borrowing costs remain elevated. This combination creates long-term challenges for policymakers because servicing larger debt becomes increasingly expensive when interest rates stay high. Governments may eventually face difficult choices between controlling deficits supporting economic growth and maintaining financial stability. Gold investors understand why this matters. Throughout history, rising debt combined with uncertain fiscal conditions has often increased demand for safe haven assets. Precious metals cannot eliminate economic risk, but they have repeatedly served as stores of value during periods when confidence in traditional financial systems becomes uncertain. Another important factor involves the labor market. Employment data remains one of the Federal Reserve's most closely watched indicators. Strong job growth may encourage policymakers to maintain restrictive monetary policy for longer. Slower hiring or rising unemployment could increase expectations that future interest rate cuts may eventually become necessary. Every employment report therefore becomes another major event for precious metals markets. Investors are no longer reacting only to inflation numbers. They are examining the complete economic picture, including wages, consumer confidence, retail spending, manufacturing activity, housing, and business investment. The bond market also deserves careful attention. Treasury yields continue influencing investment decisions around the world. Higher yields attract capital because they offer relatively safe income opportunities. This can create temporary pressure on gold because some investors shift money toward fixed income assets.
We are following breaking economic
news
this
history
morning
demonstrates that this relationship changes over time. If investors begin expecting slower economic growth or easier monetary policy, bond yields often decline while gold becomes increasingly attractive. Financial markets constantly adjust to changing expectations. The direction can reverse much faster than many people anticipate. The US dollar remains another major influence. Currency strength reflects investor confidence in economic conditions, monetary policy, and relative global performance. A stronger dollar generally weighs on gold because it increases costs for international buyers. A weaker dollar often creates support by improving affordability across global markets. Yet the dollar itself depends on changing expectations. If markets believe the Federal Reserve has finished tightening monetary policy, currency trends may shift. Gold
if we look at the data visualization on the main screen, the upward trend in emerging markets is undeniable. This changes our year-end forecasts.
Silver introduces another fascinating layer to this discussion. Unlike gold, silver benefits from expanding industrial demand as well as investment demand. Solar energy continues growing around the world. Electric vehicle production keeps expanding. Artificial intelligence infrastructure requires advanced electronics. Semiconductor manufacturing remains essential for modern technology. Nearly every one of these industries depends on silver. This creates a unique opportunity because silver does not rely solely on investor sentiment. Industrial consumption provides an additional source of long-term demand. If economic activity remains resilient, while investors also increase precious metals exposure, silver may outperform gold as it has during several previous bull markets. Central bank buying continues supporting the broader precious metals story. Around the world, monetary authorities have accumulated gold at historically strong levels over recent years. This trend reflects growing interest in diversification and long-term financial security. Unlike short-term traders, central banks generally invest with multi-year or even multi-decade horizons. Their continued purchases send an important message. Large institutions responsible for managing national reserves continue recognizing gold as an essential strategic asset despite short-term market fluctuations. That steady demand creates an important foundation beneath the market. Market psychology also deserves attention because emotions often influence prices as much as economic data. During periods of optimism, investors frequently chase high-growth assets. Technology stocks, artificial intelligence companies, and other fast-growing sectors attract enormous capital. Gold sometimes receives less attention during these periods because investors become comfortable taking greater risks. But market leadership rarely remains permanent. Every major investment cycle eventually changes direction. Assets that appear overlooked today sometimes become tomorrow's strongest performers. Gold has repeatedly demonstrated this pattern throughout modern financial history.
Do not sell yet.
Another issue attracting growing concern involves geopolitical uncertainty. Conflicts, trade disputes, political instability, and disruptions to global supply chains continue affecting financial markets. Investors cannot accurately predict every future event, but they understand that uncertainty often increases demand for defensive assets. Gold has earned its reputation over centuries rather than decades. Whenever confidence weakens, investors frequently return to precious metals because they represent tangible assets that exist outside traditional financial systems. This role becomes especially valuable during periods of elevated uncertainty. Historical analysis reveals another remarkable pattern. Many of the strongest gold rallies began while public sentiment remained skeptical. Investors questioned whether inflation would continue. They debated future Federal Reserve decisions. They worried about stronger currencies and higher interest rates. Yet beneath that uncertainty, long-term demand quietly continued building. Professional investors often recognize these shifts before they become obvious. Instead of reacting emotionally to every headline, they analyze broader macroeconomic trends. They study central bank behavior, government debt, inflation, expectations, currency markets, and long-term capital flows. This wider perspective helps identify opportunities that short-term market participants may overlook. Today, several of those long-term trends continue pointing toward an environment where precious metals deserve careful attention. Inflation remains above historical comfort levels. Government debt continues expanding. Central bank buying remains strong. Industrial demand for silver continues increasing. Global uncertainty has not disappeared. Monetary policy expectations continue evolving with every new economic report. None of these factors alone guarantees higher prices. Financial markets remain unpredictable, and short-term volatility will almost certainly continue. Yet when several supportive trends begin, aligning, experienced analysts take notice because history suggests these moments often precede significant market moves. The most interesting part is that Kevin Warsh and Jamie Dimon are not discussing isolated issues. Their comments connect to the same broader themes that have influenced every major precious metal cycle during the past several decades. Inflation, confidence, monetary policy, debt, financial stability, and long-term economic resilience all intersect in ways that could shape the next chapter for both gold and silver. And there is one final development now emerging that may become the deciding factor for precious metals investors. If this trend continues unfolding over the coming months, it could completely reshape expectations for gold, silver, and the global financial markets in ways very few people are currently anticipating. The final development is the one that many investors may be overlooking today. Expectations are beginning to change. Markets are no longer focused only on where interest rates are today. They are becoming increasingly focused on where monetary policy could be 6 months from now. This shift in expectations has historically marked the beginning of major moves in both gold and silver. Financial markets always look ahead. By the time the Federal Reserve officially changes policy, investors have usually been adjusting their portfolios for weeks or even months. This is why gold sometimes rises while economic news still appears mixed. The market is responding to the future rather than the present. If inflation remains more persistent than expected, policymakers may have to keep interest rates elevated for longer. That could create additional short-term pressure on precious metals. However, if economic growth begins slowing more rapidly or labor market conditions weaken, investors may quickly begin expecting future rate cuts. That change in expectations has often provided powerful support for gold throughout history. Kevin Warsh has repeatedly emphasized that restoring long-term confidence requires credible monetary policy. Investors understand that credibility matters because inflation expectations influence nearly every financial market. Once confidence begins changing, capital flows
The timeline
often
highlights
change with
key
it.
economic cycles.
Jamie Dimon has
Note
also
how during
continued
periods of
reminding
recession,
investors
precious
that markets
metals
should not become too comfortable. His warnings about government debt, global uncertainty, and financial risks suggest that investors should prepare for multiple possible outcomes instead of assuming current conditions will continue forever. History shows that periods of confidence can change very quickly. Economic expansions eventually slow. Inflation cycles evolve. Central bank policy changes direction. Currency markets reverse trends. Investors who recognize these transitions early often find themselves in stronger positions than those who simply react after the headlines appear. Gold has survived every major financial crisis of the modern era. It has remained valuable through inflation recessions, banking stress, geopolitical conflicts, and changing monetary systems.
The inflation trajectory is concerning.
That long history explains why central banks continue adding gold to their reserves despite changing market conditions. Silver could also become one of the biggest beneficiaries if market expectations begin shifting. Industrial demand continues expanding through artificial intelligence, renewable energy, electric vehicles, advanced electronics, and modern infrastructure. At the same time, investment demand has the potential to increase whenever uncertainty rises. This combination creates an environment where silver could experience significant volatility, but also meaningful long-term opportunity.
A secure global financial network.
Another important factor
protecting wealth
physical
at its
demand.
very core.
During periods of lower prices, many long-term investors continue purchasing physical gold and silver instead of reacting emotionally to market swings. Dealers often report increased buying whenever corrections create attractive entry points. This steady accumulation helps provide long-term support beneath the market. Institutional investors are also watching closely. Pension funds, wealth managers, family offices, and sovereign investors continuously evaluate portfolio diversification. Gold has historically served as an effective diversifier because it often behaves differently than stocks and bonds during periods of financial stress. The relationship between gold and the US dollar will remain critical moving forward. If the dollar maintains its strength, gold could continue facing temporary resistance. If the dollar weakens because expectations surrounding Federal Reserve policy begin changing, precious metals may receive renewed momentum. Investors will therefore continue watching every inflation report, employment report, and Federal Reserve statement with extraordinary attention. Geopolitical developments remain another unpredictable variable. Financial markets dislike uncertainty because uncertainty increases risk. Whenever unexpected events disrupt global trade, energy markets, or international relations, investors often return to traditional safe haven assets. Gold has repeatedly demonstrated its ability to benefit during these periods because confidence becomes one of the most valuable commodities in the world. Looking back over the past 50 years reveals one consistent lesson. Every major gold bull market experienced moments when investors believed the rally had ended. Every correction created fear. Every period of weakness caused some investors to abandon their positions, yet history repeatedly showed that temporary pullbacks often became the foundation for much larger advances. This does not guarantee that history will repeat exactly the same way. Every economic cycle is different. Every Federal Reserve faces unique challenges. Every inflation period develops under different circumstances. But history provides valuable perspective because human psychology rarely changes. Fear and optimism continue driving financial markets just as they have for generations. The current environment contains many of the same ingredients that supported previous precious metals cycles. Inflation remains above long-term targets. Government debt continues growing. Central bank demand remains historically strong. Industrial demand for silver continues expanding. Global uncertainty remains elevated. Interest rate expectations continue evolving. None of these forces have disappeared. The question is not whether gold and silver will experience more volatility, because volatility is a normal part of every market. The real question is whether investors remain focused on daily price movements, or whether they recognize the larger economic trends developing beneath the surface. Kevin Warsh reminded investors that monetary credibility matters. Jamie Dimon reminded investors that risks remain. Central banks continue buying gold. Governments continue managing record debt. Markets continue adjusting expectations almost every day. When all of these pieces are viewed together, the precious metals story becomes much larger than any single trading session. Gold and silver have never been investments built around short-term excitement. They have always represented patience, discipline, and long-term thinking. Investors who understand this often avoid making emotional decisions during periods of temporary market weakness. Instead, they focus on broader economic trends that unfold over months and years rather than days. The coming months could become some of the most important for precious metals investors in recent history. Every major economic report will shape expectations. Every Federal Reserve meeting will influence markets. Every inflation update will affect investor confidence. Every geopolitical development will create new opportunities and new risks. Whether gold moves higher immediately or experiences additional short-term volatility, one fact remains clear. The forces driving today's market are complex and constantly evolving. Investors who remain informed and understand the relationship between inflation, interest rates, the U.S. dollar central bank buying government debt,
if we look at the data visualization on the main screen, the upward trend in emerging markets is undeniable. This changes our year-end forecast.
If you found this analysis valuable, please like this video and subscribe to Silver and Gold Watch for more updates on gold-silver inflation, Federal Reserve policy, and the global economy. Turn on notifications so you never miss our latest market analysis. I would also love to hear your opinion. Do you believe Kevin Warsh and Jamie Dimon are warning investors about something much bigger ahead? Do you think gold and silver are preparing for their next major rally, or do you expect more downside before the trend changes? Share your thoughts in the comments because your insights make our community stronger. Until next time, stay informed, stay patient, and keep watching the markets because the next big opportunity often appears when the majority least expects it.